Okay, hello everyone. I am recording this tutorial. So we are talking about tutorial number 7, and tutorial number 7, we are talking about credit risk, and credit risk is actually single loan credit risk and portfolio risk. When we talk about single loan credit risk, we are talking about three issues actually: the selection risk, we are talking about underwriting risk, and we are talking about the operational risk, which means where before we give the loan, we have to select the right borrower, and after we do that, we are talking about drafting the contract, which we call the underwriting risk, and that contract has to be very carefully, designed and priced. And then after we give the contract, we have to maintain, watching and revisiting the contract and saying with the checking with the agreement is going as per the contract. Now, the reason I'm saying this because here, because of the large quantity and large volumes of loans, we have to go to something called credit scoring. And credit scoring means you have to develop some type of system. This system will allow you to score the customers, score the defaulting according to our history. And then for any application, you will check any application according to the characteristics uh, and the information of the new application, and see whether it meets the what we call the benchmark or no. If it meets the benchmark, then you give the loan, and if it doesn't, you just reject the loan. Uh, to let you know what we are talking about, see, if you look for the for credit card, for example, as the video which I gave you, we have age, we have income, we have maybe profession, location, maybe address, number of dependents. All of those actually is very important issues for the bank to know about you. So now what banks do, they do something called regression analysis. Now regression analysis is actually, they will regress the default, the probability of default, for example, which it's coming in the as a function of all those things, see, age, income, and you continue with all those variables. And you can add as much as you can. The regression will tell you which one is important and which one carries the highest weight. Now, when the regression tell you that, you just take that model. So you take, for example, the defaulting people for the last 5 years or 6 years. You take all the loans for the last 5 years and 6 years or 10 years maybe. If you are, for example, trying to take a credit card. And in the credit cards, they will give you who are the defaulted, the defaulting. And so in the defaulting, they will tell you, for example, in the defaulting, in the Z value, for example, for Eltman, which we will talk about it, they give you something like 181. And therefore, 181 and above, you can give the loan. And then the more the customer scores, the more you give. The more you decrease the premium and you accept that loan. And this is your benchmark, because under this point, you don't accept because it will default. The customer will default. Not because he will default, because every single customer in his characteristics, in his income, age, and profession and location defaulted. And most probably, he will default. This is how the credit scoring works. Now, this is one thing. The other thing we want to know is the pricing. Now, the pricing, we have two issues. We have what we call contractual rate, but we don't get that one. We get actually the expected, which is after the defaulting. If you take all those, if you take all your assets, maybe 3%, 4% of them defaulting. So the expected actually, if you have 4%, which means you have only 96% receiving, giving back your dollar, your principal, and your K. And this is the expected R. So if you take this and you minus it from 1, which is the principal, you will get the actual rate actually you are getting, because you are losing from the principal and also from the these 4% from the principal and also from the interest. The contractual is what the customer will sign, or the this loan applicant. Now, I want to talk first about this issue, and then I will talk about the credit scoring. Let's talk about this issue first. Let's go to problem number. This is a loan offers 9%, straight 2.5% premium, charge 25-cent loan. So this is the this is actually the, I give $1. That $1 will receive the dollar plus the interest, which is again, it's this $1 plus the K. Now the K is coming like this. You have to charge fees, and these fees annual basis. I mean, it's continuous. It's not only for one time. It will continue all as long as the loan is in your books. Plus the basic rate, which is the free rate, plus the premium. And this is actually coming under the, you have to decrease it from something called compensation balance, -1 minus R. Now, we understand this, just the fees, and this you take it yearly, every year, as long as the loan in your books. This is the basic rate. You can take it from central banks. And this is the premium, which is depends on how risky this customer. And it will depend on the Z value. Actually, for most retail loans and most business small loans, is the same. But if you have somebody who is getting very still accepted but risky, then you can play with this and increase it or decrease it. What the new thing I think for you is the B, the compensation balance. And the compensation balance is like this. When we take a business loan, and by the way, we are discussing only here business loans in this example. So you have, the bank will tell you you have to participate in that loan. So 10% in the project, for example, and we finance you with 90%. But actually you don't pay. So they will keep 100,000. They will release 1 million. They will release 900,000 and 900,000 and keep 100,000. And when it happens, then in this case, actually, this is almost 10%. This will increase the rate. This will increase the rate. So actually, because you divided this by amount of less than 1%, less than one, which will increase this rate. The other thing is the R. R is the deposits. When you receive $1 deposit in this country, for example, you only can lend 96 cents, which is 4%. 4 cents has to go to the government. So in this case, also the bank are smart. They pass these costs to the customer. So this is the 4% here. And this is for the 10%, for example. I want you to understand this very carefully because this is actually it affects this formula of pricing. Now, according to the example, as you can see, the fees, I have no problem with it, which is the fees is the rate, as you can see, is 9%. The premium is 2.5%. Compensation rate is 1 minus 10%. And this is 6%. And the reserve is, and you can calculate this. And if you calculate it, it will become 97%. As you can see, we calculated to be 14 and 12.97. We have no problem with that. And everything is fine. The next question is, which one is the most important component in this formula? We can calculate without the B, we can calculate without the R, and we can calculate without the fees. Because this you have to charge, which is the L, the basic lending rate, and the M you have to charge. So without the fees, if I calculate without the fees, it will be 11.75. Excuse me, if I calculate without the B, the compensation balance, the rate will drop from 12.97 to 11.75, which means I lost this file. Okay, I think this is our file. So if we drop, actually, if we, it was 12.97, we calculate it without the B, we'll get 1175, which is a drop of 1.22%. If we drop the fees, the rate will drop from, the change will be 1269, which means from 1297 to 1269. So we are talking about actually 28 basis point drop. If we drop the reserve requirements, then the rate will be 13.6. So the difference will be just 0.09. So actually, the biggest is the compensation balance, as you can see. And therefore, when you go to a bank and you negotiate a loan, you be careful about how much they want to keep as compensation balance. They tell you this is your participation. Okay, we give you the loan of 1 million, but 10% will be retained or 5%. This is actually very sensitive because when you negotiate the rate, you don't know the effective rate. What you know is they will tell you that we are charging a basic lending rate of, like here, they are charging 9%, and they are charging you a premium of 2.5%. Maybe they will tell you about the fees, but the rest of the things you don't know. So you have to be careful how much they charge fees, and because this is the contractual, this is actually the nominal rate. The rate which you will pay, then it's different, and it's not actually in the contract. So if they can tell you it's 9%, the basic rate, and we have a premium of 2.5, so it's 11.5, but actually you end up paying 1297. These things you have to be careful. Now, this is one thing when you understand the pricing. The other thing also, when from the bank perspective, if you are going to get 1297, and the category of this loan belongs to those loans who have 5% defaulting. Now, in this case, you have to understand what to do. So in this case, the expected rate, you just bring the K, 1 plus the K, which is 12.97%. And this is actually has a probability of payment of 95%. And this is will make it 732. See how much is the drop? The drop is huge. The drop is actually from 1297, which you calculated, to 732. Why is this huge drop? Because the 5% is actually you are going to lose from the principal and the interest, as I told you. Now, this is some other, the next thing I want you to know. The third thing is when there is a collateral. Now, what is a collateral? A collateral is type of security. For example, if you will be working for any of those companies, SMEs or bigger or medium companies, usually those companies have factories, have land, have all these things. So if you want to expand actually your borrowing and you are looking for a loan of 1 million ringgit, 2 million ringgit, in this case, they will ask you to put your assets. Maybe if it is like a really a big company, they will ask you to put land, the machines, the cars, everything, and you have to make sale for it. Conditional sale. If you don't pay, they will confiscate the asset. And therefore, in this case, we have something called collateral. So here, the collateral, for example, so the payoff now will be when you default or when you don't default. So a bank has made a loan of 10%. This is the K. If it expects probability of default of 5%, it expects a 5% default. Now, if the loan is defaulted, it expects to recover 50% of its money through sale of collateral. This is the collateral, which is the asset you bought. And therefore, the payoff for this, the payoff actually for this loan is the probability of payment of the principal plus the interest and the probability of defaulting. This is the two probabilities we have. Now let's look at the probability of payment. The probability of payment is actually the probability of payment plus the principal times the interest. The probability of defaulting, because the probability of payment is 95%, the probability of defaulting is actually 1 minus the 95, which is actually the 5%. So you have to bring the probability of defaulting times the 1 of plus K, which is the same thing, times the collateral. So as you can see here, this is the probability of payment, and this is the probability of defaulting. And this is the collateral. So to calculate, according to our example, so the probability of payment is 95%. We know this is 10%. And we know this is 5%, just minus 95. Or you can say 5% if you like. 1 plus 10% times 0.50 times 50%. And if you calculate this, of course, minus 1, you will find it to be 725%. This is actually if you have a collateral and you have according to these conditions. So I want you to understand how we do the pricing, how we calculate the K, how we calculate the expected R without collateral, and the expected R with collateral. Okay. So we are done with this question of the pricing. Now let's go to the next issue, which is the, as I told you, the this issue, which is the any question? Can I proceed? Any question in this stage? Anyone? So far, no questions. Good. Thank you. Thank you. Thank you very much, Ali. Thank you, Princess. Thank you, Federico. Everybody, thank you. Okay. Now let me go to the next question, which is this one. This is the a typical what we call credit scoring. Now this credit scoring, if somebody tell me where did I get the 1.2, 1.4, 3.3, all those coefficients, we call them coefficients, already has been obtained from the regression analysis. The regression analysis will give you these coefficients. All you have to do is when any company comes to you and this is a business loans, and this is a model for business loans, you have to calculate X1, X2, X3 according to that company, and then get the Z value. So we have three models for the linear probability modeling. We have what we call linear probability model, but this model has the problems because their values can be out of the one. The probability can be more than one or less than zero, which doesn't make sense. And then they try to behave that and use the logit model where they can restrict the probability of defaulting between 0 and 1. And third one is the Eltman, which is this one we have. Eltman Z. Now, Eltman Z, they already gave us, and this is a worldwide model. They told us if the Z is actually less than 181, reject that loan. If the Z actually bigger than 181, but less than 299, consider, which you call it critical area. And if the Z is actually higher than 299, this is accept. And they give us the model, and you have to have a balance sheet. They will give you a balance sheet. And then maybe you take an average for few years balance sheet, or you take of that year, and you can calculate the X1, X2, X3, X4, X5, put them in the formula and calculate the Z value. Now, according to the problem we have today, this is the, and the X1, X2, X3 actually are defined. So look at the problem we have today. Let me just erase those ones very fast. So the problem we have today, this is the problem. We have this balance sheet and we have this information. And we have also this information. And we want to calculate the X1 and the X2, X3, and X4. Now, I know what is X1 and X2. X1 is, as you can see, X1 is the working capital over the total asset. So I need to calculate the working capital, and X2 return earning over total assets, and X3 earning before income and tax over total asset. And this is the market value of equity, and sales over X5 is the sales over total assets. So I want to calculate the working capital. I know working capital is current assets minus current liability. Current asset is this one. And current liability is this item, this item, this item, which is 150. So 200 minus 150, which make it 50. I want to calculate the earning before income and tax. So to calculate it, the balance sheet is we have sales of 500. We have cost of goods sold. This is the sales, 360. So we have EBIT, earning before income and tax, of 140. And then we have interest of 40. And we have actually net income. No, this is income before tax. This is earning before the tax, 100. And then you have the tax, which is, they say it's 56. I end up with net income of 44. This 44 going to, according to the information, 50% will be paid as dividends. Net income 44, the dividends payout is 50. So this is 22 return earning, and 22 is actually dividends. Now I can calculate my things. I have, so working capital, I have it. I have earning before income and tax, which is already defined it to be 100, 140. I have net income, and I have the return earning, which is 22. Now, if I have all this information now, I am in position now to calculate the, so as you can see, the working capital is 200, total asset is 700. Working capital is actually 200 minus 150, remember, which is this one minus all those ones over the 700. So I get the X1. Now for the X2, which is the return earning, I find it 22 according to my calculation. The total asset is from the balance sheet is, it's clear. The total asset is 700, as you see here. It's 700, the total assets. So, and then I have the X3, which is the earning before income and tax. We already calculated to be 140. And the total asset is 700, fund that. And then the market value of the equity, they mention it clearly that the market value of the equity is equal to the book value. And they mention it here, the market value of equity, equals to the book value. How much the book value? The book value is actually 400. So now I go and calculate this. So it's 400 over the 150, which is the long-term debt. Long-term debt, according to the balance sheet, is also 150. And then the last one, sales, which is 500. We already know it, over the total asset, 700. And then I calculate this one. I just plug these numbers in the model, and I find 3.04, which is the Z value. Now, my question to you, accept, reject, or consider this loan. Which one you will take and why? My question to you guys, please chat with me or talk. Should I accept the loan? Oh, okay, I have a chat here. And the chat is saying, I cannot see the chat, why? The chat say, accept because more than 299. Thank you very much. Your answer is just correct. Francis is saying also accept. Federico is saying accept. Everybody is saying accept, so we just accept it. Now, let's go to whether we can do something else. If we go with the same information, but we go here, here is the same information. However, the sales, I want to see whether this model can capture really and reject the loan. These people, last time they make 500 sales and their income was 44, in which they pay dividends of 22. Now this sales has dropped actually 40% to 300. And probably they are making losses because if it is 300 minus 360, their cost of goods sold, they are already making 60 down here. And then they are making 40 for the interest. And then they are making already 100. And because they are making losses of 100, they will get a tax benefit because when they get profit of 100, they pay a tax 56. When they get losses for 100, of course, they will get a benefit or 56. Okay, so we take the 56, they ended up minus 44. I just want to see whether Altman can capture this issue because this company, if I give them the loan, they are already losing. And I should actually, if this is actually their data, this company is the minus place. Give them the loan, you are just, they will default for sure. So I started now to do the calculation. I calculated X1, which is the same thing. Current asset minus current liabilities over total assets. I have no problem with that. But now X2, which is the retained earning over the total assets, retained earning, the net income over the net income over the total asset, it's minus 44 now, as you can see. And now earning before income and tax over total assets is minus 60 already, as you can see. And then the equity over the debt, the equity they say here, I think they told me here, the market value of the equity was only half book value, which is very logic. If you are making losses, the market will perceive you very bad. The market cap of the company will drop dramatically. And this is why actually the book value even double the, almost double the, it's double uh, the, uh, the market value, which means the company is going down. So I bought 200 over the debt, 133, and then X5, which is the sales over the total asset, 426. I go and I put those numbers, and if you put those numbers, you will get it less than 0.9348. This is the Z value. So the Z value is actually, and actually I don't want to ask you, but I want maybe to hear you. So reject, right? Reject, right? Any chatting? Reject. Yes, reject. And this is because we reject. So the model actually, sorry, the model actually is helping me, identifying the right companies. Of course, there is so many criticism about these models, but Eltmans is stronger than the linear probability model. This is a discriminant one. Okay, so if this is all the calculation we have for today, let me now go to the theory issues. Now, the theory issues, we want to introduce ourselves. We want to know the loans, but I want to tell you something. This class is not concerned with the financial products of the banks. It's not part of our concern. Our concern is actually the risk, but we have to understand the loans nature and also the issues associated with the loans that will affect the risk. For example, we want to know something like some of the issues we want to know, like Let me just take some space here. We want to understand issues like spot loans. What do we mean by spot loans versus committed loans or loan commitment? This is one issue. The second issue, we want to understand, what do you mean by secured? Remember, those terms, all of them actually related to the risk, because we are talking now about security, secured versus unsecured loans. And also, when we want to control our risk, we talk about the term and conditions of the loans, which is the underwriting issue. We call it loan covenant. Loan covenant. Covenants. Okay. So the loan covenants is actually the terms and conditions that we imply, like the leverage, like the liquidity, all those issues when we give the loan to the customer, so we be sure that the loan will be paid back. Now, let's start with the first issue. How does spot loan differ from loan commitment? A spot loan is just, I give a loan, you take it immediately. It's immediate takedown of the loan amount by the borrower. You apply, maybe you approve it this week, I take it end of the week. That's no problem. Or they transfer it to my account within this week or the next day of approval, and that's it. The loan commitment is, borrowers can benefit from this. And if you have some information about derivatives, it looks like an option, because it's like a call option, because I will sign a contract with the bank will give me the loan, I will pay a fees, these fees called upfront fees, and then it's up to me to take the loan or not to take the loan. For example, I signed a loan of 8%, but then, or 6%, and this is what I want to pay. But then, and this loan will be taken after 2 years, and I want to fix this rate. So in the future, it can go to 8%. The loan commitment will allow me to take the loan with 6%. But if it goes to 4%, the loans now in the market, I may not take it. I may not take it. But of course, they will charge me what we call back end fees. So when I sign the contract, I will pay this fee. When I finish, for the amounts that is not withdrawn, they will charge me this fee. If I withdraw 100%, there is no other fee. There is no back fee. But this, I will pay it all the time. This only if this is all the time. This is only if not withdrawn. Now, actually, it has some advantage. The advantage, if the interest rate increases, the borrower can borrow as needed as predetermined rate. If the rate declines, the borrower can borrow from other sources, which means he can go for the 4%. Disadvantages, you have to pay those fees. This is from the borrower perspective. Okay, let's go to the next issue. Differentiate between secured and unsecured loans. Just take the collateral. The collateral word, which is the security. Now, this is a synonym for security. And the security can be any type of assets. So a secured loan is backed by collateral that is Somebody is asking for um, Zaman. There is no code today. There is no code. Code starting from
Okay.
tomorrow. Yeah, starting from
Okay.
tomorrow.
Thank you.
Yeah, sure. Yeah. So lender has a right to the collateral that can be liquidated to pay all or part of the loan. So according to the information we have, I have another question about from, I know, for international students, they told us the practice of giving the codes will start on the 20th of April, not from today. Today is just the 19th. So it's from this week, your class is from tomorrow, you get the code, not today. So the practice of getting the codes and keying the codes will start for tomorrow. Understand, my friends? Yeah, yeah, this is what, okay, so we have what we call um, collateral. The other thing which we want to talk about it is when we have a fixed loans, fixed rates against variable rates. When we have a fixed rate, and a fixed rate, the lender of the loan bears the risk of interest rate changes. In other words, if the interest rate goes up, for example, if I give a loan of 6%, housing loan for 30 years, and the prices goes to 8%, now in this case, I cannot increase to 8%. I would just check 6%. So I have 2%, which is opportunity cost. I'm losing that one. But if the interest rate drop, I will be benefiting. So I give 6%. If the interest rate drop to 5%, my customer still pay me 6%. But anyways, just a practice here in Malaysia and other countries, all the loans are actually floating rates. And when we say floating rates, they will tell you pay the PR, basic rate, plus my premium. The premium can be fixed. The premium can be fixed. But this basic rate keeps zigzagging, going up, going down, and therefore the rate will go up and go down. The total rate, the K, will go up and down according to this. So this is what I want you to understand. Housing loans, car loans, all those loans, especially business loans, floating rate. Actually, businesses, when they come to the loans, they want a floating rate. They don't want a fixed rate. It's only me and you who are employees and receiving fixed income. We want fixed rate. Okay, number three, what are the covenants? Covenants, as I told you, is the term and conditions, and bank can tell you you have to have a leverage ratio. For example, your debt to your assets should be 70%. And I will give you the loan according to this. No more other loans from other lenders, sorry, or other banks. So you cannot increase and go next time and next year, and I see this ratio is becoming 90%. That will not happen. If I'm negotiating a big loan with you, then this is one of the conditions. The second condition, they will tell you, I need cash flow enough to pay my profit, my interest and my principal. So no dividends. Your shareholders should accept that issue. Don't go and please the shareholders and pay dividends for you, especially if you are an owner and own part of this company. So no dividends at all. And the third one, they will tell you to maintain networking capital, uh, maintenance of And this is just to let you to be sure that actually you are operating, and you are operating in a safe way, that you are not stuck with the operating capital and your operations are not stopped. The operating capital is very important because you need to buy inventory, you need to buy for the labor, you need to pay for the rent, for all those utilities before the sales, before the account receivables actually matures and your customers paying to you. So the accounting, so this working capital is very important for the what we call the cash cycle. So you have to have to have, they can put it as dollar or as a percentage of your total assets or sales, can be percentage of sales. So the working capital be part of that. So this is actually very important, and therefore you have to make the bank knowing what you are doing, and therefore there is what we call quarterly financial statements. This is actually the positive things of it, and this is the negative things. Anyways, if, if if the bank receive all this and follow those covenants, which means the operation of the company, they can actually better monitor the loan. They can monitor the loan. They can monitor the company and the loan. Look, this is all every 3 months, which means always quarterly. So this is one issue. This is the last point I think I will talk about today, which is the credit scoring. Now, credit scoring is, I told you, it comes from a regression. And in the regression, when I see, for example, in the Eltman, when I say the Z is 1.2x1 plus 3.3x2, and they continue with this one. So they will identify factor of importance. We will identify this x1, which is, as I told you, the net, the working capital. For example, this is the working capital over total assets. So they know that the working capital is important. So you will identify all those ones, and you will evaluate the degree of importance. How we evaluate it? This is only 1.2, but 3.3 is more important. The coefficient is higher. So this variable is actually more important than this one. So you will identify first the variables, and you will put the weights through the coefficients. And now the Z value can be 181, right? Still you can accept. But what if a company come with 185 and another company come with Z of 5? This is very quality loan. This is okay, even if it is 3, still okay, but this one high. So when you make the K, which is the fees plus the risk, the basic rate, plus the M, when you calculate it, 1 minus B, 1 minus R, you can now play with this M. If this is 5 or 10, this is very, very strong company. So I will decrease the M. So this is actually helping me, the credit scoring, to play with the premium, which is my risk premium for the defaulting. So actually it helps me in identifying the factors, as I said, which is x1, x2. Tell me to define this one, the coefficient. Give me the Z value, which let me evaluate the issues of evaluate the value of Z, and then adjust the M, which is the premium. And most importantly, screening bad loans and good loans. Anything, if the Z value less than 181, rejected, finish. Okay, so that actually screening bad loans and more efficiently calculating the necessary reserves. So if I am taking most of the loans, which is most of the companies 181, 182, 183, this will help me actually in evaluating the risk and allocating a correct number or dollars to the provision of bad debt. Okay, actually, I will stop here. I think it's 5:02 now. This is just when we this question. Just I will finish this and so actually when we want to control the lending to the wholesale, we can talk to them about the quantity of loans or the price. So we decrease the quantity of loans if we want to decrease the the risk of more applications, and we can increase the price. So we can give first loan 12%, second loan 14%, 12% for the machine, 14% for the inventory, 16% for the working capital, and we continue. So these people actually will decrease the quantity of the loans, and it will I can control the quantity of the loans and the risk. But for wholesale, for retailers, which is credit cards, car loans, individuals like me and you, the only thing to do is if you increase the rate, they will take. You tell them 20%, they will take. 25%, they will take. But you decrease the quantity of the loans. You cannot give housing loans and car loans and credit card loans and school loans and tourism loans and all those packages. So actually the quantity of the loans price is not significant for this category. This is the whole thing about this question. And actually I am done with this tutorial. And if you have any question, please ask me. Okay, thank you very much. If there is no questions, and thank you.
Thank you, sir.
Thank you. Bye-bye.
Thank you, sir.
Thank you. Good day. Bye-bye. See you.